Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It's December 16th, 2025, and today we're connecting three threads that keep showing up in the same sentence: AI chips, the Fed's 2026 lineup, and China trying to get consumers to open their wallets again.
Hi, I'm the guest, and I brought three moods: AI chip FOMO, Fed tea leaves, and please don't tell me my next phone costs more. I'm here to ask the questions you're too embarrassed to Google.
Story 1. An AI chip designer called MetaX is debuting in Shanghai, and it's landing in the middle of a broader investor frenzy around anything that smells like compute. Whether you're buying stocks or just watching the hype, the signal is simple. Risk appetite is alive and well in the AI chip lane.
When I saw MetaX trending, I thought Zuckerberg renamed Facebook again. But no, it's chips. So this is like your neighborhood gets one trendy coffee shop, and suddenly every garage is a specialty roastery, except the espresso machine costs billions and drinks electricity like a small country.
Exactly. In hot sectors, IPOs can pop because demand for the story is bigger than the available shares. But here's the trap: narrative compression. When everyone already believes the bull case, the stock needs near-perfect execution just to justify the price, let alone go higher.
If you buy at peak hype, your portfolio becomes a donation to someone else's retirement. So what's the normal person move? Avoid it or buy the shovel sellers instead of the gold miners?
Here's a simple checklist. 1. Size it like a speculation, small enough that a 50% drawdown doesn't change your life. 2. Demand proof, not vibes. Revenue visibility, customer concentration, and whether the company can ship at scale. 3. Zoom out. If multiple AI chip IPOs are stellar at the same time, that can be a sign of easy liquidity, not necessarily durable returns.
So we're not anti-AI. We're anti-paying luxury prices for a basic hoodie. And speaking of basics, my phone is begging for mercy. Please tell me the next headline is not, "Your upgrade now requires a loan officer."
Story 2. Counterpoint research projects average smartphone selling prices could rise in 2026. The figure being cited is about 6.9%. The basic idea is that more advanced chips and tighter supply can push costs up, and manufacturers try to protect margins by nudging prices higher and steering buyers to premium models.
So I have to pay more for a phone so it can use AI to write my emails for me? That feels like buying a blender that costs double because it also tells me I'm making the smoothie wrong.
Here's a helpful mental model. Chips are like airplane seats. AI data centers have reserved a huge block early, and now everyone else, phones, cars, appliances, competes for what's left, often at higher prices. That doesn't mean every device gets more expensive forever. It means pricing power shifts when supply is tight and demand is urgent.
Okay, practical question. Do I buy my next phone before 2026 and stop pretending my cracked screen is character? And investing-wise, is the answer really just buy chip stocks and pray?
2 angles. Personal finance. If you're due for an upgrade in the next 12 to 18 months, consider timing it earlier or budgeting a higher replacement cost. Same logic as planning for higher insurance premiums. Investing. Treat AI demand like a cycle. Watch CapEx, utilization, and pricing power. The winners aren't always the loudest tickers. Sometimes it's the boring suppliers with steadier contracts.
Boring suppliers, the beige cardigan of investing. Not sexy, but it keeps you warm when the hype draft hits. Speaking of drafts, can we talk about the Fed? I feel a rate breeze every time I open my mortgage app.
Story 3. The Fed 2026 Watchlist. Even before a single rate move, markets care about who's voting and who's shaping the message. And with leadership speculation heading into 2026, the market isn't just pricing inflation and jobs, it's pricing the people interpreting inflation and jobs.
So it's like a group chat. Same data, totally different vibe depending on who's typing. And bond traders are basically reading tone indicators for a living.
Practical takeaway. Transition years can mean extra volatility around speeches, minutes, and surprises. For your money, keep your emergency fund rate agnostic. Don't chase yield so hard you add risk you don't understand. For investing, match bond duration to your timeline. If you need cash in 12 to 24 months, you don't want a portfolio that gets whiplashed by rate moves. Quick fourth thread to tie this together. Reports say China is rolling out a consumer spending push, often described as an 11-point package, aimed at getting households to spend more and helping domestic demand carry more of the growth load.
Governments everywhere, please spend. Consumers everywhere, with what money? If the plan leans on easier credit, is that bullish? Or is it just kicking the can with a fancier can?
It can be both. Policies can lift near-term activity, but demand is more durable when it's confidence-led and income-led, not just loan-led. If you're watching for whether it's working, keep it simple. Look for follow-through in retail sales momentum, consumer confidence, and credit conditions, not just announcements.
Recap: AI chips are hot, exciting until you remember heat can burn. Phones might get pricier in 2026, so plan upgrades like an adult, unfortunately. And the Fed's 2026 cast matters because markets are basically a reality show with spreadsheets.
Your action list from today. Keep speculative positions small. Budget for higher replacement costs on big-ticket tech. And align your cash and bond duration with your real timeline heading into 2026. If this was useful, subscribe and share. And tell us in the comments, what worries you most for 2026? AI hype, rate volatility, or everyday price creep?